Okay, am I audible?
Yes, sir.
Okay. Good afternoon, respected Chief Guest, Sri Pradeep Kumar, Assistant Commissioner, GST Trivandrum Division, respected Speaker of the Day, Sri C.A. Bhanusekar Sir, Conference Chairman, Sri C.A. Sadishan P., beloved Chairman of all the branches, branch committee members, and dear participants. A warm good afternoon to all. Today, we are on the 5th day of our NAVARATNA conference, which is hosted by Kollam branch. I am proud to be a part of this program, and my sincere thanks to all other branch chairmen, especially Palakkad, Thrissur, and Kottayam, for their sincere effort in conducting the program. As discussed and decided between all the 9 branches, under the guidance of C.A. Sadishan Sir, we put our maximum efforts in finding the best faculties for the relevant topics, and we are sure that our efforts will make this event a remarkable one in the NAVARATNA history. In this platform, I request all the branches to think of having a common platform for the students' training also, which may help them in getting knowledge from the most eminent faculties in their academic subjects. Our profession has seen many evolutionary changes over the last few years. In an increasingly complex, demanding, and competitive century, we still need to push the boundaries and rise beyond the ordinary. Common gatherings like this can motivate us personally and professionally. With these few words, let me welcome our Chief Guest, Assistant Commissioner GST, Trivandrum, and also in charge of Kollam Division, Sri Pradeep Kumar Sir, to this conference. Welcome, sir.
Thank you.
I also invite the faculty of the day, our best choice to handle the topic, penalties and prosecutions, Sri C.A. Bhanusekar Sir from Chennai. Sir, welcome, sir.
Welcome.
Next is our beloved conference chairman, Sri C.A. Sadishan Sir. With his humble talk, hardworking attitude, along with his Thrissur slang, made him our beloved leader. I welcome you to the seminar, sir. Next, I would like to welcome the chairpersons of all the branches along with their committee members. The success of every meeting is the strength of participation. I invite all those who are participating in today's seminar to this session. With these few words, let me conclude my welcome assignment. Now it is the time for inaugural speech. Before that, I invite C.A. Nitin, Vice Chairman of Kollam branch, to give a small introduction about the chief guest.
Good afternoon, everyone. Today, we are fortunate to have Sri Pradeep Kumar, Assistant Commissioner, GST Range, Trivandrum Division, as our chief guest. Pradeep Kumar sir joined CBIC in the year 1994 as an inspector. He had worked in Kochi, Calicut, and Trivandrum as inspector and superintendent. He got promoted as Assistant Commissioner in the year 2020 and held charge of Palakkad GST Division from August 2021. He joined in Trivandrum Commissionerate in August 22 with additional charge of Kollam GST Division. I invite Pradeep Kumar sir to address the session. Sir, please.
Okay.
Sir, I invite you to deliver the inaugural speech. Welcome, sir.
Okay. Good afternoon, everybody. I am audible?
Yes,
Yes,
sir.
Okay. 2 days before, Mr. Sabu invited me to inaugurate this 5th day of Navarang webinar, which is being arranged by the Kollam branch on the subject how to deal with penalties and prosecution. I was informed by Sabu that the webinar is for the members of NDR, members of the Kerala ICAI, and the faculty of today's webinar is Bhanusekar sir from Chennai. My sincere thanks to Kollam chapter for inviting me to inaugurate this webinar. I am representing the Central Board of Excise and Customs. I think the department's close association with your community is decades old, which grew with the introduction of service tax and more strengthened with the introduction of GST. Now the department is also getting more dedicated service from the members of your learned community, and the department is availing the services of your members for conducting various training programs to staff members and department's national training schools throughout India, and also for the outreach programs conducted by the department. that the CEO community's role in the tax collection and development of nation is very important, and the department will always be thanked to you people. I think the topic allocated for the Kollam branch is also very interesting one. Under the tax laws, various penalties are imposed based on the specified offenses, but the prosecution is initiated against a few taxpayers as a strong deterrent against potential tax evaders. Further, the legal provisions also provides for waiver of penalties or reduced penalties and the compounding of offenses to taxpayers who opt for availing such voluntary complaints. And I hope today's faculty will go through such provisions also. I hope that the 3-hour section will surely enlighten the participants with the law and its practical approach for the better guidance of the taxpayers. With your permission, I hereby inaugurate the section and wishing the faculty and all other participants a good day. Thank you very much.
Thank you, sir. Now, I invite our conference chairman, C.A. Sadishan sir, to address the conference.
Thank you, Chairman. Chairman of the session, Kollam branch, Sabu CS, and our today's chief guest, Kumar sir, Assistant Commissioner of GST. Sir, thank you for your nice words. Anyway, GST, as you said, from service tax, this era, and now the GST, our fraternity, our institute is supporting you in many manner. And now also our institute indirect tax committee giving so many classes to the inspectors, joint commissioners and commissioners in various corners of India. Yes, and institute is planning in December, most probably in December, to have an all India conference of all joint commissioners and commissioners with a session. The place and venue is on process. Okay. So I hope that we can do from our side, from an institute side, yes, to a little bit to empower or to get more knowledge to both of us from yes, what is our perception as far the department is concerned and what is our view regarding the clients and our knowledge regarding the subject. So it will be a mutual benefits process. Yes,
sure.
Thank you, sir, for inaugurating this program. And our expert, today's expert, income tax, penalty and prosecution, Bhanusekar sir is a well-known speaker. Everybody knows that. And sir, we are all expecting that what will be the penalty going to impose or how we can escape from at least the tax audit session. You know, everybody is very much attention regarding the tax return filing on 31st October and some of them not able to complete the tax audit itself on September 30th. So if there is any provision to or any way to get out of that penalty proceedings, it is very good because many of the chartered accounts are not able to complete because of the assessees are not completely corrected their accounts. So we are not able to complete that accounts in before September 30th. Many of them, some of them already completed. Many of them not able to complete the audit of tax audit as well as 31st October. We are going to filing the return and that the process is pending. So I hope that Bhanusekar sir will detail explain the penalty and prosecution matters and he is very expert. There is no there is nothing to say regarding you, sir, because you know well all the branches you visited in Kerala and the 9 branches of Kerala joining together. We are conducting this Navaratna. Then I congratulate the Kannur branch chairman Shiv Prasad, Calicut branch Santosh Paisar, Palakkad one and only one diamond of the Navaratna Anuja Jayakrishnan, then Ernakulam KV Josar, Thrissur Rajit Kaimal, Kollam branch chairman, the hosting, sorry, Kottayam Sabu Thomas, Kollam branch, the present hosting branch Sabu CS, and Trivandrum Cherian Samuel, and other managing committee members. We are halfway completed. Today is the 5th day. 4 more days to go. This is a feast. Every day we are having different type of taste and different type of product or food we are eating as a CP seminar. So I hope that everybody will enjoy the program and get enriched with the subject knowledge. So once again, I congratulate all the branches for conducting this program in a nice manner. So other 4 days also, we are going to, I wish all the success for the next 4 days also. And with this, I once again thank you, Pradeep Kumar sir and Bhanusekar sir, for your coming here and participated in the program. And I congratulate all the branches for the wonderful seminar on Navaratna. Thank you.
Thank you.
Okay, Pradeep Kumar sir, we are continuing the session. If
Okay,
time permits, you can join us also.
Yes,
It is according to your time. Okay, now it's the time for starting the discussion on today's topics, penalties and prosecutions under income tax law. We have with us the most eminent faculty who can talk on this subject. Sir, we are blessed with your esteemed presence. I request you to handle the session. Before that, I request Sri Darshan sir, our treasurer, to give a formal introduction about the speaker. Over to you, Darshan sir.
Thank you, sir. Good afternoon, one and all. Welcome to the 5th session of Navaratna, All Kerala CPE Seminar. We, the Kollam branch of SIRC of ICAI, is elated to host the 5th session on how to deal with the penalties and prosecutions. The session will be led by CA Bhanusekar. He has been in practice for 28 years and is a partner in Messrs. CRBS and Associates LLP. He is a distinguished person in the field and has argued in a number of landmark cases before benches of Income Tax Appellate Tribunal across the country and also in various benches of the Settlement Commission. He has contributed articles on direct tax and international taxation to several tax journals and also authored books. His notable works are Handbook on Assessment Procedures under Income Tax Act 1961 and Search and Assessment under the Income Tax Act. Moreover, he has served as a visiting faculty at the Institute of Chartered Accountants of India, Institute of Company Secretaries of India, and the Loyola Institute of Business Administration on direct tax and delivered lectures and presented papers on direct taxes and international taxation at seminars, meetings, workshops, and conferences arranged by the ICAI. He has also worn many other hats, like served as the chairman of Direct Tax Committee of Hindustan Chamber of Commerce, served as a member of SIRC of ICAI, and served as the chairman of Fiscal Law Committee of SIRC of ICAI, being a few of them. Sir, it's a great honor and privilege to welcome you to the session. I request you to please take over the session, sir.
Thank you, Mr. Darshan. The chief guest of the evening, Mr. Pradeep Kumar, chairman of all the branches who are here organizing this big, huge conference, and my dear friends who are attending. It's indeed an honor to be part of this program. It's an honor to be part of this program where they are organizing a program with 9 branches together. In fact, when I was called and requested to handle this session, I was actually thrilled because I have not been able to visit any of the branches in Kerala for some time now, thanks to the pandemic and all the confusion that has been taking place. So I'm actually very happy that I'm able to meet all the branches at one time. In fact, I would have loved to be physically present in any one of the conferences with the Kerala branches. But unfortunately, as I was saying, the pandemic has come and things have become that much more difficult. Well, Mr. Satheesan who was talking about the penalty under 271B, etc., where we were talking about what happens in a case where the tax audit cannot be completed, etc. Now, the only way to get over a penalty under any of the provisions for non-compliance, like a failure to have the tax audit provisions complied with within the stipulated time, is that one has to show reasonable cause for the failure. And that is provided for in 273B of the Act. Now, what can be reasonable cause may depend from circumstance to circumstance. But then I have one very interesting case which I argued long back, as Mr. Satheesan was talking, I was reminded, where we had argued saying that the accounts were not ready and that therefore we could not conduct the tax audit and consequently penalty is not exigible. Reasonable cost being that accounts are not ready. The department said having the accounts not ready is an offense. I said that offense is separately punishable if at all under 271A and not under 271B. The reasonable cause for the failure to have the accounts audited is the failure to have the accounts completed. But then you will also remember the penalty for failure to maintain proper books is 25,000, whereas here it is 1.5 lakh. So that much, 1,25,000 can still be the saving. So we can think of various reasons, including saying that the accounts are not ready, or being able to demonstrate that the accountant was not in a position to complete the accounts, or was not in a position to support the chartered accountant during that time, probably because of health issues or whatever be the reasons. These could be reasons which we could think of as a reasonable cause. But then there is no one hard and fast rule as to what can constitute reasonable cause for a failure. But so long as one can demonstrate that there is a reasonable cause, the penalty is not exigible, is what we can talk about. Now, moving from 271B, or rather to the penalties which are not income-based, to income-based penalties for a little while, for us to be able to appreciate the difficulties that we may face in relation to the quantification of income by the department. Particularly after the faceless assessment has come into being, I think things have become a lot different. Earlier, we were able to sit across the table, demonstrate or explain to the revenue authorities that this was the correct position in facts, for us to be able to make them understand why exactly a particular addition should or should not be made. But unfortunately or fortunately, with the advent of technology, there have been a lot of changes that have happened. And a scenario has arisen where now we are almost completely in a faceless assessment scheme, except in case where there are transfer pricing matters or where the matter is before the central circle after a search or a survey operation. So except in those cases, the assessments are almost literally now faceless. Now the faceless regime has its own advantages, but then until we get completely adjusted to the scenario, I think it has more disadvantages than advantages. For the time being, we are finding that it is very difficult for us to factually make an officer understand. I'm not blaming the department, I'm not blaming the system, I'm not blaming the chartered accountant, I'm not blaming justice. But the fact remains that it is becoming increasingly difficult without a personal interaction for us to make an assessing officer understand very complex theories and entries, etc., that have been made in the books of account. And this has also resulted sometimes in unwanted additions, which probably may not stand the test of time. But be that as it may, that is the practical scenario that exists today, and we may have to live with it for some time before matters get settled. Now, we are also aware that there are the advent of some new provisions relating to penalty, particularly in relation to income-based penalties. I will start with section 270 capital A, which is the income-based penalty for a variance in income. Now, friends, you will recall that earlier we had penalties which are exigible under 271(1)(c), where the penalty was exigible for concealment or furnishing of inaccurate particulars of income. Penalty was exigible under 271(1)(c) for concealment or furnishing of inaccurate particulars of income. Now, 271(1)(c) started off like this. It started off with saying the assessing officer, commissioner appeal, the principal commissioner or the commissioner, in the course of proceedings under this act, is satisfied that any person has concealed the particulars of his income or furnished inaccurate particulars of such income. So there were two limbs to it: concealed particulars of income or furnished inaccurate particulars of income. Now, very clearly, there are two independent limbs. Concealment of income is different from furnishing of inaccurate particulars of income. Now, the issue, first, one of the major issues that arose, I'm saying this because this has more significance in the context of the new 270 capital. Now, one of the issues that arose in the context of 271(1)(c) was, in the show cause notice, that is the penalty notice, should the assessing officer state whether it is a case of concealment of income or furnishing of inaccurate particulars of income. We had various decisions, including the decision of the Karnataka High Court in a case called SSA Meadows, as also the Madras High Court in a case called Original Kerala Jewellers, where they said that whether it is a concealment or furnishing of inaccurate particulars should be made known. It should be made known to the SSC even through the return of income. Sorry, even through the show cause notice. Now, the question that rose subsequently was, what happens if it was not made known to the SSC in the said show cause notice? The High Court held that if that is so, then the penalty proceedings itself could not have been initiated properly, and that therefore the penalty has to fail. Am I audible? Because
yes, sir.
Yes,
You are
sir.
audible.
Yes, sir.
You are audible.
if somebody has sent a message on the chat, are there any audio issues?
You are audible. Yeah.
Yes. So we had a situation where various high courts had held that if there is no mention as to whether it is furnishing of inaccurate particulars of income or furnishing or concealment of income, the penalty cannot be levied at all. Right? This was the various decisions. In fact, SLP had been dismissed by the Supreme Court also. Now, yes, bear this in mind. This is more and more, this will be more and more important as we proceed into 270A, because I feel that under 270A, the burden that is cast on the department is a lot higher than the burden that is cast on the department in terms of 271(1)(c) of the Act. I shall come back to that. But in the meantime, you will recollect that 271(1)(c) had 7 explanations below it, which are technically 8. Because if you say 5 and 5A, then you had 8 explanations below section 271(1)(c). Each of these explanations provided penalties to be exigible or not exigible in certain cases. And explanation 1 provided for something like this. It said the person fails to offer an explanation or offers an explanation which is found by the AO or the Commissioner of Appeal or the Principal Commissioner or the Commissioner to be false, or such person offers an explanation which he is not able to substantiate and fails to prove that such explanation is bona fide. So, there are 3 circumstances. 1, he fails to offer an explanation or offers an explanation which is found to be false. There are 2 circumstances. 1, no explanation at all. 2, explanation found to be false. The third is he offers an explanation, but he is not able to prove that such explanation is bona fide. Right? But he is not able to prove that such explanation is bona fide. What does this mean? He is offering an explanation. He is not able to demonstrably show it to be right, but at the same time, he is able to reasonably demonstrate that the explanation is a possible explanation. Penalty is not leviable. So explanation one provides for a situation where he fails to offer an explanation, offers an explanation which categorically is found to be false. That is, the officer proves in the affirmative that the explanation is false. Or three, he offers an explanation. It is not found to be false, but the assessee is not able to demonstrate that it is a bona fide explanation. So if he is not able to demonstrate it to be bona fide, then also penalty is exigible under 271(1)(c) by virtue of the first explanation to 271(1)(c). You have explanation 2 to section 271(1)(c), which is probably one of those most complex explanations. In fact, if you read that explanation, it contains only one sentence. And that one sentence comprises of 279 words. It comprises of only one sentence, which comprises of 279 words. There is no full stop at all in between. Of course, there are commas and all of it, but there is no full stop at all. Again, this explanation also has to be noted very carefully, because a similar explanation will be found in 270 capital A also. And there is a lot of significance to this in the light of the amended provision. Explanation 2 provides in simple words to say that if you are having an addition that is made in your case, and if you are not able to offer any explanation and additions are made, however, the assessing officer, for reasons best known to him and to you, does not levy penalty. But if you use this addition as a source in a subsequent year, then in that subsequent year, note very carefully, in that subsequent year, penalty will be levied. I'll take a simple example. There is a credit in your books of account. The assessing officer adds this credit as your income, but does not levy penalty. Let's say the assessment year 14-15, the addition is made, penalty is not levied at all. In the previous year 11 to assessment year, say 16-17, that is in the previous year 15-16, 11 to assessment year 16-17, if you take credit for this unexplained credit, saying this is the source for some investment or some expenditure in the financial year 15-16, then penalty will be levied. In the assessment year 16-17, please note, I repeat again, the addition was made in assessment year 14-15. You took source credit in the previous year 11 to 16-17, and the penalty therefore will now be leviable in the assessment year 16-17 by virtue of explanation 2 to 271(1)(c). This has a lot of significance even under the amended provision. Kindly bear this in mind. I shall come back to this as we start dealing with 270 capital A in a little while. Explanation 3 to section 271(1)(c) says if there is a failure to file a return within the time stipulated in 153, Even though you may file a return in response to a notice under 148, penalty will be leviable under 271(1)(c). So failure to file a return within the time stipulated in 153 can also result in a penalty under 271(1)(c). You have explanation 4, which deals with two different scenarios. One is where your deemed income, your MAT income is varied, or two is where your loss is reduced or your loss is converted into income. As explanation 4 provides that even in these circumstances, penalty would be exigible and provides for the working mechanism therefore. Explanation 5 is not very relevant because it deals only with searches conducted prior to the first day of June 2007. Explanation 5A deals with cases where there is a search after the first day of June 2007, but deals with years other than the specified years, the specified years being the previous year of search and the immediate preceding previous year, provided the time limit for filing the return for that immediate preceding year has not expired. So penalty would be leviable even in such circumstances for those years other than these two specified years by invoking explanation 5A. Explanation 6 says that if there is a 143(1) adjustment, no penalty would be leviable. And explanation 7 says that if there is a TP adjustment, a transfer pricing adjustment, then penalty would be leviable under the provisions of 271(1)(c). This is a very brief gist about 271(1)(c). I am sure you will recall many of the decisions that are rendered in the context of 271(1)(c), like MacData, where they said that the onus is on assessee to demonstrate that the material supplied by him is correct. Otherwise, penalty can be levied. You will also remember the decision in Reliance Petro, where they said that if there is an inadvertent failure, penalty will not be leviable. We also have the decision of the Supreme Court in Price Waterhouse, where they said failure to report a 40A7 disallowance in the return of income, while that was reflected in the tax audit, will not result in a penalty. But kindly note, all of these were decisions rendered in the context of 271(1)(c). And 271(1)(c) is applicable only 271(1)(c) is applicable only up to assessment year 16-17. From assessment year 17-18, the provisions of 271(1)(c) would not apply, and what would apply would be the provisions of 270(A). Therefore, let us start analyzing the provisions of 270(A), which is more relevant in the present context. I discussed 271(1)(c) for two reasons. One, up to assessment year 16-17, 271(1)(c) is still relevant. And two, for us to have an understanding, a better understanding of section 270(A), a reasonable understanding of 271(1)(c) should probably be there. That is why I had a quick recap of 271(1)(c). Now, what does 270(A) provide for? If you see the opening clauses of 270(A), it says where the assessing officer, the commissioner of appeal, the principal or commissioner may, in the course of proceedings under the Act, direct that any person who has underreported income shall be liable for penalty in addition to tax, if any, on the underreported income. Now, recall the provision of 271(1)(c). It says that the assessing officer, the commissioner, the principal commissioner, or the commissioner of appeal is satisfied in the course of proceedings. Now, the words "is satisfied" is found absent in 270 capital A. Why is it found absent? You will understand as we proceed and in a little while from now. Actually, that doesn't require an explanation. That requires a little more understanding of 270 capital A. Now, I'll quickly go on to subsection 2 of section 270 capital A. Subsection 2 of 270 capital A provides for circumstances in which a person is supposed to have underreported income. Circumstances in which a person is said to have underreported income. Now, there are actually 7 different circumstances, but we can group them into 3. The first 3 being one group, where they say, A, the income assessed is higher than the income determined in the intimation passed under 143(1). The income assessed is higher than the income determined in the intimation under 143(1). B, no return of income has been filed, or where return of income has been filed for the first time under 148 and the income is higher than the maximum amount not chargeable to tax. C, the income assessed or reassessed is higher than the income that was already assessed or reassessed. So first, a regular assessment being made, it is the income determined is more than 143(1) income. 2, no return is filed, or where return is filed for the first time under 148, then the income is higher than the maximum amount not chargeable to tax. And 3, where the income is reassessed, the income that was originally assessed is to be reduced. This is one category. The second category is in respect of deemed income. D, E, and F of subsection 2. D says the deemed total income under the provisions of MAT or AMT is higher than the deemed total income determined in an intimation under 143(1). 2, it says no return is filed or return is filed for the first time under 148 and the deemed total income under the MAT or AMT provision is higher than the maximum amount not chargeable to tax. You will see that it is very similar to your regular provision. And 3, it says where the deemed total income reassessed under the MAT or AMT provisions is higher than the income already assessed or reassessed. This is the second grouping. The third is solitary, where it says the income or assessed or reassessed reduces the loss claimed or the loss is converted into income. That is, you return a loss of say 10 crore, the assessing officer determines the loss at 7 crore. The 3 crore can be subjected to penalty. Or let's say you return a loss of 2 crore, the assessing officer determines the income at 1 crore, income positive. Then again on the 3 crore differential, penalty can be leviable. Right? So I have grouped the variances into 3 categories. Now there are a number of issues that rise. I'm afraid I will have to say that the law has been drafted in a little bit of a haste and requires a lot of fine-tuning. But then one thing you will notice, that unlike 271(1)(c), It says concealment or furnishing of inaccurate particulars of income. Subsection 2 does not say it. It says the minute your income is varied, you may become liable for a penalty. Right? Now go further into some of the issues that arise as a result of subsection. Right? In fact, I was telling you that these sections have been drafted with a little bit of a haste. A classic example of the haste is, if you see clause E, it says that if you have not filed return of income and your deemed total income under the MAT or AMT provisions are varied. Now, one thing that probably has to be borne in mind is that the AMT provisions come into effect only if you, through a return of income, claim Chapter 6A deductions, certain Chapter 6A deductions, or certain deductions under Section 35 AD, etc. If you don't file your return of income, the AMT provisions have no significance at all. But then the law is contemplating of a penalty even there, which is actually impossible. That is probably just a drafting lacuna. There are several such lacunae that are there, which we will be dealing with as we proceed, and how to tackle it. But then this may be an innocuous mistake which will not harm anybody. Right? But then interestingly, it talks about loss being reduced. If you see the last clause of 72A2, it talks about loss being reduced or loss being converted into income. So if you return an income of nil and the assessing officer determines the income at nil, no penalty is leviable. So let us say my business income of the current year is 10 lakh. My business income of the current year is 10 lakh. My brought forward business loss is 25 lakh. So I set off 10 lakh and show a return income of nil. The case is taken up for scrutiny. The assessing officer makes an addition of 10 lakh. So according to him, the business income is 20 lakh. He has to set off the brought forward business loss, which is available to me to the extent of 20 lakh. So I was saying the balance carried forward was 15. The assessing officer will make the balance carried forward to become 5. He will carry forward that balance only. Right? So what does he do? He determines my income to be nil again. I returned an income of nil. To repeat, 10 lakhs was a business income, set off brought forward loss up to 10 lakh, though I had a business loss of 25 lakhs, balance nil. Assessing officer, income 20 lakh from business, brought forward loss to be set off 20 lakh, because I have another 15 lakhs of business loss left. Income assessed nil. What is the penalty that is exigible? The penalty that will be exigible will be nil. The penalty that will be exigible will be nil in this case, because the section does not contemplate a levy of penalty when income determined and income assessed are one and the same in the present circumstance. This again seems to be a drafting lacuna which does not seem to have been covered up. Now, subsection 3 provides for determination of the unreported income. Friends, can you bear with me for a minute? I'll just join you. Sir?
Okay, sir. Okay, sir.
1 minute, sir.
ചെറിയ സാറേ ക്വസ്റ്റ്യൻ ആൻഡ് ആൻസർ വർക്ക് ചെയ്യുന്നുണ്ടോ? ചെറിയ സാറേ സാറേ മ്യൂട്ടാണെന്ന് തോന്നുന്നു സാറ്.
മ്യൂട്ടാക്കി.
ആ ക്വസ്റ്റ്യൻ ആൻഡ് ആൻസർ എനിക്ക് തോന്നുന്നു ചിലപ്പോൾ അത് വർക്ക് ചെയ്യാതെ വരുന്നുണ്ട്. ഞാൻ തൃശ്ശൂരിൽ നിന്ന് പറയാം.
അതെ അതെ. Some issues there.
Yeah. കൈമൾ സാറേ ഒന്ന് തൃശ്ശൂരിൽ അഡ്രസ് ചെയ്യണേ. സാറിന് എല്ലാം പോകുന്നു.
ടൈപ്പ് ചെയ്യാൻ പറ്റുന്നില്ല സാറേ ക്യൂവിന്റെ.
അതെ ഞാൻ ഇൻഫോം ചെയ്യാം.
Audio clear അല്ല. Starting മുതൽ audio
ഓഡിയോ ഒക്കെയാണ് സാർ.
I already given the chat box. Audio ശരിയാവുന്നില്ല. കാലിക്കറ്റ് ശരിയാവുന്നില്ല.
ഓക്കെ നമുക്ക് ഓഡിയോ ഇഷ്യൂ ഇല്ല. ഓക്കെ ആണ്.
ലോഗൗട്ടിന് വീണ്ടും കയറിയാലും
Sir, may I, sir?
Yes, sir. You can continue.
Okay. I'm extremely sorry that I had to take this break. Am I audible, sir?
Yeah, audible, sir. Audible.
Yes. Now we were dealing with subsection 3, which deals with the determination of underreported income. Now, each word has to be very carefully understood in the light of the present provisions, because they seem to have been drafted sometimes, I'm sorry, in a very slightly mischievous manner as well. We sometimes don't understand where we are getting stuck, but we are getting stuck without proper replies to each one of these. Now, the subject matter is how to face these penalties. But we need to understand what the penalty provisions are to understand what to face. Now, determination of the amount of underreported income, largely it says that where a return of income has been furnished, the difference between the income assessed and the income that is determined under 143(1). And 2 is where you have not furnished the return of income, the income assessed minus the maximum amount not chargeable to tax. Right? So that is what it largely provides for. So what happens in such circumstances? We are talking about a case where your income is assessed for the first time. Where your income is assessed for the first time, if you have furnished a return of income, the difference between the assessed income and the income that is determined under 143(1) means that you will not be levied a penalty on the 143(1) adjustment. If you have not filed a return, or if you are filing a return of income for the first time in response to a notice under 148, then the income assessed minus the maximum amount not chargeable to tax will be the amount on which penalty will become exigible. This is in a case where you are being assessed for the first time. What if you are being reassessed or recomputed? It says the income presently assessed minus what is earlier assessed. And what if there is a reduction in losses or conversion of losses into income? The amount of adjustment to income will be the deemed concealment of income. I think I explained this even in the context of 271(1)(c), where the amount of adjustment to the income will be the deemed concealment of income. And here it will be the deemed amount on which penalty will be leviable, or the deemed underreported income. Right. Now, as I was saying, there are a number of lacunae even here. Now take a case where you have a return loss of 20 lakhs. Your 143(1) income is determined at minus 10 lakh. I'm sorry. And your 143.3 income is determined at plus 10 lakh. Now, what will happen in such a case? It says the assessed income minus the 143.1 income. So, assessed income minus the 143.1 income will become minus 10 lakhs minus of minus 10 lakh, which will be 20 lakh. Right? But since your loss has been converted to income, please note, if you are being assessed for the first time, you should compute the penalty as 10 lakh minus of minus 10 lakh, that is 20 lakh, which is the amount of addition made in 143.3 proceeding. But there is another clause in subsection 3 which says, if your loss is converted into income, the difference between the loss returned and the income assessed. So that is 10 lakhs minus of minus 20 lakh, which is 30 lakh. A penalty, the underreported income becomes 30 lakhs in this case, in which case, if you are a loss returned assessee, even a 143.1 adjustment can be subjected to penalty. So you will have to make it very, very clear that you cannot be liable for penalty on any income adjustments made under 143.1. Otherwise, you are likely to end up with a situation where the officer can resort to some kind of a funny working like this. Likewise, if you recall the provisions 270A, it says penalty can be levied by the assessing officer, the commissioner, the principal commissioner, or the commissioner. Commissioner or principal commissioner in the course of 263 proceedings, and the commissioner appeal in the course of appellate proceedings if they make any adjustment or variance to the income. Now let us assume a situation where the assessing officer determines my income at 25 lakh, whereas I returned an income of 10 lakh. The underreported income will be nothing but 25 lakhs minus 10 lakh or 15 lakh. Now let's say you go to the commissioner appeal against the addition, but the commissioner appeal feels that an enhancement is required in this case. Your income should be determined not at 25 lakhs, but at 42 lakhs. Right? Now, penalty workings. Income that is assessed by the commissioner appeal minus, a plain reading will tell me minus the income returned or 143.1 computed income, which is 10 lakh. So 42 minus 10 is 32, which means on the difference between 10 and 25, there is now going to be a double penalty. So you have to make it very clear to commissioner appeal that if at all he wants to levy penalty, penalty will be exigible only on 42 lakh minus 25 lakh of income. That is the underreported income. Right? That is the underreported income. It cannot exceed those numbers. Now, while talking about the provisions of 270A3, you may also for a minute consider dealing with the various provisions which deal with how to quantify the tax on the underreported income. But before we go to determining the tax on the underreported income, I will deal with subsections 4, 5, etc., so that there is larger clarity on how they are really structuring the whole thing. Subsection 4 and 5 are akin to explanation 2 to 271(1)(c). Friends, you will recall that I spent a little while explaining the provisions of 271(1)(c), second explanation, where I said if an addition is made in assessment year 14-15, but if you take source credit in 16-17, penalty not having been levied in 14-15, then in the year in which you take source credit, penalty will be leviable under 271(1)(c). Yes. Now, a corresponding provision is made in 270 capital A by virtue of subsections 4 and 5. Say, for example, you take and make an addition in assessment year 17-18, penalty is not levied under 270 capital A. In assessment year 19-20, you take credit for that. In that assessment year, penalty can be levied under 270 capital A. Now, what they don't seem to have provided for, and what somebody can take advantage of, is that they have not provided for what will happen in a case where addition is made under the old regime when 271(1)(c) was applicable. But source credit is taken in the year in which the provisions of 270 capital A are applicable. If you take my earlier two examples, I said addition made in 14-15, source credit taken in 16-17, penalty under 271(1)(c) leviable in 16-17. Next example, I said addition made in assessment year 17-18, no penalty under 270A levied in 17-18, source credit taken in 19-20, penalty is leviable in 19. No problem in this. But let's assume an addition is made in the previous year relevant to assessment year 14-15. It is made in assessment year 14-15. Source credit is taken in 17-18, not 16-17. In assessment year 17-18, kindly note, friends, that penalty under 271(1)(c) is not exigible because 270A has taken over. So 271(1)(c) cannot be levied in 17-18 when source credit is taken. Can I levy penalty under 270A? No. Subsection 4 and 5 only contemplate where you escaped penalty under 270A in an earlier year. Penalty can be levied in a subsequent year under 270A. But here is a case where 270A was not escaped. What escaped was 271(1)(c) penalty. The lawmaker does not seem to have provided for it at all. Now we have subsection 6, which talks about circumstances where an income is said not to have been underreported. An income is said not to have been underreported. Now, before we proceed to subsection 6, one very important thing we will have to remember. If you look at 271(1)(c), it specifically talked about concealment of income or furnishing of inaccurate particulars of income. Whereas 270 capital A talks of underreported income and tells you a formula to work out the underreported income. They seem to be relying more on mathematics in the context of 270 capital A. My personal view is that 270A cannot be construed as a pure mathematical working. I am saying this because if you look at it that way, then you will almost literally come to the conclusion that 270A is a mandatory penalty. The minute any adjustment is made, penalty is automatic. No, that is not how it is. And that will be clear when you read subsection 6. Subsection 6 provides for 5 circumstances in which 270 capital A is not exigible. One, the SC offers an explanation to the AO or the Commissioner of Appeal or the Principal Commissioner or the Commissioner, and the explanation is found to be satisfactory or bona fide. Then no penalty is to be levied, provided the SC has disclosed all material facts to substantiate the explanation. Now, this is slightly, not on the same lines as explanation 1 to 271(1)(c), but slightly similar lines. If one were to go to 271(1)(c), first explanation, fails to offer an explanation, offers an explanation which is found to be false, or offers an explanation which is not bona fide, right? Or which he is not able to prove is bona fide. Whereas here it says, he offers an explanation. So if you don't offer an explanation, you are hit. He offers an explanation, and the concerned authority is satisfied that the explanation is bona fide. Whereas there it says that it is found that you have failed to prove it to be bona fide. There must be a failure on your part to prove it bona fide. Here you must satisfy somebody that it is bona fide. To that extent, there is a distinction. So you will find that 270(a) is slightly stricter. But while that is said, you will remember that this explanation itself goes to demonstrate that 270(a) is not mandatory in nature. You have 4 other circumstances contemplated by subsection 6. And what are they? The accounts are correct. 2, accounts are correct and complete to the satisfaction of the AO or the Commissioner of Appeal or the Principal Commissioner or the Commissioner. But the method employed cannot be used to properly deduce the income. I have tried my best to understand what they are trying to say by this. I have you maintained correct accounts, but you cannot find out the income from that means. I don't know what it means. Honestly, I must express that despite reading it for the last 3 years, 4 years, I have not been able to understand what they are trying to say. If I have maintained my books correctly, you should be able to determine the income correctly. I have maintained books correctly, but you are not able to determine income correctly. How a situation like that can arise itself, I don't understand, but they have provided for it. 3 is where the assessee has estimated a lower addition or disallowance, but the estimate made by the assessing officer is higher. But then for this to be invocable, you must have made an estimated disallowance. So a mere estimated disallowance from the assessing officer is not enough to escape the penalty under 270(a)(6). 3. What is required is that you must be able to show that you estimated a particular loss or disallowance, but the assessing officer determined a lower or a higher disallowance to be made or addition to be made, then this clause is invocable. The 4th is very, very important again, not just because of the importance of the 4th exclusion, but because of how important it is for us to understand that 270(a) is not a mandatory penalty. I'm not going to deal with the depth of 270(a)(6), the 4th exclusion for the moment. I'll just mention what it is, and I will come back to you when I deal with subsection 8. What does this provide for? It says the SC has maintained information and documents prescribed under 92D, declared the international transaction under Chapter 10, and disclosed all material facts relating to the transaction. Then, even if a TP adjustment is made, no penalty is levied. Just remember this much, I will come back to this. And the last item is where there is an underreported income on which penalty is leviable under 271 AAB. They say if penalty is leviable under 271 AAB, then no penalty will be leviable under 270 capital A. Now coming to the quantum of penalty. The quantum of penalty will be either 50% of the tax or 200% of the tax. When is it 50% of the tax? It is 50% of the tax when the assessee is said to have underreported income, and 200% of the tax when the assessee is said to have underreported income as a result of misreporting of income. When can one say that somebody has misreported income? See, there are two categories now that I am creating. Underreported income, underreporting as a result of misreporting. 50% for underreporting, 200% of the tax for underreporting as a result of misreporting. So for convenience, we'll call it underreporting of income and misreporting. Underreporting 50% of tax, misreporting 200% of the tax. And subsection 9 says when income is said to have been misreported. And again talks of 6 situations. 1, where there is misrepresentation or suppression of facts. Misrepresentation or suppression of facts. 2, where there is a failure to record investment in the books of account. 3, when there is a claim of expenditure not substantiated by evidence. 4, when there is a recording of a false entry in the books of account. 5, when there is a failure to record any receipt in the books of account having a bearing on the total income. And lastly, a failure to report an international transaction or a deemed international transaction or a specified domestic transaction. Now, the 6th scenario you will see deals with deemed domestic transaction, deemed international transaction, or an international transaction. Now, on the contrary, if you go to subsection 6, subsection 6 talks only about an international transaction. So when do you escape penalty under 270A6? When you maintain the complete particulars, etc., of international transaction. Does it mean you have maintained all particulars of international, deemed international transaction, etc., but an addition is made to TP? Penalty is leviable? No. Unfortunately, there seems to be a drafting error there. While in subsection 9, they have referred to international transaction, deemed international transaction, or specified domestic transaction, subsection 6 talks only of an international transaction. That seems to be some kind of a mistake that has been committed in the drafting. So again, that goes to indicate that the penalty under 270A is not automatic. Even though something may not fall under subsection 6, penalty may not be exigible in certain circumstances. Now going further, there are again a lot of aspects on 270A9, because 270A9 seems to go on the presumption that entries are everybody will maintain books and every entry will be appearing in the books of account. No, that is not how the system works. For example, it says failure to record an investment in the books of account. If I have made a personal investment, I have bought a house for my personal use, how will it enter my books of account, which I am maintaining in the course of carrying on my business or profession? There is no mandate for me to maintain books of account on my personal basis. Can they immediately jump on me and say, you have not incorporated this in your books of account? Again, my answer should be no. You should read it in context. Right? Likewise, they are saying, failure to record any receipt in the books of account which has a bearing on total income. That should be relating to a business activity. For example, if I have let out my house property on rent, individual, personal house property on rent, I am also carrying on the profession of chartered accountants or advocacy or whatever. Will the failure to make the entry in the books of account of the business or the profession in respect of the house property income make me exigible to the penalty? The answer should be no. So, in a way, 270A9 is also very poorly drafted. Now, I will come to one of the most important questions. Right? Now, you will recall under 271(1)(c), I specifically said that if there is a concealment of income or furnishing of inaccurate particulars of income, various high courts have taken a view that the assessee, various decisions are there where the assessee will have to examine whether the assessing officer in the penalty notice has stated whether the penalty is sought to be levied for concealment or furnishing of inaccurate particulars of income. Right? Now, the question is whether penalty is leviable only in such circumstances. SLP dismissed by Supreme Court. We will take that to be the correct position in law for the time being. But in 270A, the onus is much more. The assessing officer has to state whether it is underreporting or misreporting. A. And if he feels that it is misreporting, under which clause of subsection 9 the assessee falls, he will have to state, because he has to tell me what is the charge against me. Without telling me what is the charge against me, he cannot ask me to defend myself. Honestly, friends, until date, I have not seen a single order where in respect of so-called misreporting of income, the assessing officer has told me under which clause of 270A9 he is charging me. But in my personal view, that is a mandatory requirement, because unless you tell me under what provision you are going to charge me, how will I be able to defend myself? It will be the first question. And as far as underreporting, misreporting is concerned, it becomes all the more important. It becomes all the more important because of the simple fact that if there is a case of simple underreporting of income, I am entitled to immunity under 270 270AA. But if it is misreporting of income, then a question arises, am I entitled to immunity or not? I will deal with that in a little while. But underreporting, you are entitled to immunity as a matter of right if you satisfy certain conditions. If you satisfy certain conditions, you are entitled to it. As a matter of right, no discretion is available to the AO, in my opinion. So the assessing officer has to tell you, is he levying penalty for underreporting? If the answer is yes, then he has to tell you that in the assessment order itself. Not even in the show cause notice, in the assessment order itself, while making the issue. Failure to mention will disentitle him from the levy of penalty. This is my personal view. Quickly going on to subsection 10, I shall come back to some more aspects when I deal with 270AA. Going on to subsection 10, you will recall that subsection 3 talks about the quantification of the reported, underreported income. And subsection 10 tells me how to determine the tax on the underreported income. And it comprises of 3 different scenarios. One is where my income is assessed for the first time. Then it says the tax on the income assessed plus the maximum amount not chargeable to tax. If my income has been originally assessed and if there is a loss that has been originally assessed, then what is to be done? They say that the income that has been originally determined under 143(1) is to be subtracted. Or if it has been originally assessed, then the originally assessed income has to be subtracted and the tax thereon has to be computed. And thereafter on that, penalty will be exigible. The same will happen in case of MAT or case of AMT. Now, what happens if an officer fails to initiate a penalty in his order of assessment? Whether that itself can be subject to revisionary procedure. If an officer initiates but drops penalty, then that order can definitely be subjected to 263 proceedings because you have the decision of Supreme Court in a case called Toyota Motor Corporation. But if an officer has failed to initiate penalty, then in my view, penalty itself is not exigible and 263 is also not possible in such circumstances. There are a number of other issues that may arise in the context of 270 capital A because of the way the arithmetic works. Now, for example, if there is an addition of income and there is also some deletion in the income, for whatever reasons, the assessing officer feels that some income should be deleted. Now, there is an addition made by the AO, deletion made by the AO. How will the penalty be computed? Penalty should be computed on the net addition, obviously, the tax on the net addition. But if there are 2 additions made, one for underreporting of income and one for misreporting of income, and a third adjustment, reducing my income partly. Let's say 2 additions, 10 crore and 12 crore, reducing my income to the extent of, say, 1 crore in some other reason. Now, is that 1 crore to be adjusted against 10 crore or 12 crore? Because the penalty on the tax on 10 crore is at 50% and the tax on 12 crore is at 200%. Because 10 crore represents underreporting and 12 crore represents misreporting of it. No clarity here. Again, I am telling you, they have tried to make section 270 capital A mathematical. In fact, I still remember a teacher of ours, when he used to teach us taxation, he used to tell us a joke. Right? He used to say, law cannot work with, the precision of English. He used to say, mathematics is most precise, English is less precise, and law is even lesser precise. So when you try to use mathematics to, in law, the precision with which it works makes things more difficult only. And he used to give us an example. He used to say in mathematics, if A is equal to B and B is equal to C, then you can cancel B and B and say A is equal to C. In English, if I say, I love my wife and my wife loves her sister, you can't cancel the wife and say, I love my sister-in-law. Right? This is how we used to give an example of how English works and how maths works. In the same breath, you will see that they have made 270A literally mathematical. And therefore, there are a number of issues arising on the mathematics, like what I said just now. Now, I'll quickly go on to section 270AA, which talks of immunity from penalty. Now, there is already one question that has been posted in the chat box, which I have seen, which talks about the immunity from penalty. Now, the immunity from penalty is available provided the assessee has paid the entire tax and interest. The entire tax and interest on the income that has been determined by the AO within the time allowed in the notice of demand under 156(1). That is, he must have paid the entire tax and interest before the time allowed under 156. 2, he should have an order which is passed under 143(3) or 143(3) read with 147. 3, there should be no appeal that should be filed by the assessee against the order referred to above. That is the order which you are seeking immunity. And he is supposed to make an application in form number 68 within 1 month from the end of the month in which the notice of demand under 156 is received by. Now, the question in the chat box says, will immunity be available if the order is passed under 144 and not under 143(3)? Now, I think the provisions are very, very clear. It says where an order is passed under 143(3) or 147 read with 143. So, if your order is under 144, I am afraid the immunity may not be possible. Right? 2, you must have paid the entire tax and interest within the time allowed under the notice under notice of demand under 156, and you must go on application in form 68 within 1 month from the end of the month in which the order is passed and the notice of demand is received. Now, please note that there is no scope for an AO to condone a delay. And whom do you make this application to? You make it to the jurisdictional assessing officer. Right? You make it to the jurisdictional assessing officer, and the JAO as he is called, the jurisdictional assessing officer, grants you the immunity. Immunity from what? Immunity from 270A penalty under 276C for willful attempt to evade taxes and 276CC for non-furnishing of return. But the law says that that is in respect of under-reporting of income, not expressly providing for a misreporting of income. Now, if one were to read the language in 270 capital A, it says that the penalty is to be, or the immunity is on the following basis. You pay the taxes, etc. No appeal is preferred. Application is to be made in form number 68 within the said period. The assessing officer subject to fulfillment of the conditions, etc. And it says, where the proceedings of penalty has not been initiated in the circumstances referred to in 270A9. Now, if you read subsection 3 of 270AA, it talks about not granting immunity for penalty which is leviable for misreporting of income. Of course, there is a substantial debate on whether at all it can be granted or not. Some people feel that for cases of misreporting of income, the immunity should be mandatorily granted. But in case of under-reporting of income, the immunity should be mandatorily granted. But in case of misreporting, the assessing officer may, in his discretion, grant or refuse to grant. I, for one, may not subscribe to this view. It is my view that the immunity cannot be granted if there is misreporting of income. Now, the law also provides that once immunity is granted, you should not prefer an appeal against the order. Right? So, you should not have already preferred an appeal. You should not prefer an appeal also. Now, there are a number of questions that arise in 270 capital A also. Please note that 270 AA is only for underreporting of income, not for misreporting of income. But then they seem to have been, or they seem to be looking at a very idealistic situation. What happens if in a particular order, two additions are made, one for underreporting and one for misreporting of income? Can I come for immunity? You can come for immunity, no doubt. But in my view, immunity can be granted only on the underreported income, not on the misreported income. But also remember that you should not file an appeal against the order, is the language. Which means, even against the misreporting now, you will lose your right of appeal. Why will I come then? Why will I come then? I think it would be ideal for them to look at a case-to-case, immunity. I should not take an appeal against a particular addition. But unfortunately, the law says you should not file an appeal against the order. Likewise, they do not provide for what will happen if there is no tax payable, because the mandate is that you must pay the tax, or that is there in the notice of demand. I presume that even if there is no tax payable, the immunity can be availed of. The immunity can be availed of. Also note that even where an addition is made by way of enhancement by the commissioner or the principal commissioner of income tax, the immunity is always to be granted by the AO. Now, questions may arise. What happens if my immunity is rejected? The law clearly provides that the time limit provided for filing an appeal under 249 will stand extended by the period taken during which the matter was pending before the AO for grant of immunity. So automatically your time for filing appeal before commissioner appeal will get extended, and you can file an appeal against the 143(3) order itself before the commissioner appeal. But remember, friends, there is no right of appeal against a refusal to grant immunity. If at all, you may have to file a writ in the High Court. There is no immunity. There is no immunity for the refusal to grant immunity. Now, there can be also issues like, what if there is highly debatable issues? Unfortunately, the law does not expressly provide what should be done in respect of debatable issues. Earlier, 271(1)(c) said concealment of income, furnishing inaccurate particulars of income. So, if you have relied on a decision of the courts, or if the issue was highly debatable, you could easily have argued saying that my reliance on the court order or my reliance on debatable issues in favor of assessee cannot be a reason for levy of penalty under 271(1)(c). I would think 100% a similar defense is available even in 270A. That is why I said the provisions of subsection 6 of 270A are not the exhaustive list. They are only an illustrative list. So if you can demonstrate that penalty is not leviable because the issue is debatable, I would surely think that penalty should not be levied. Because let's say you are lying. Let's say you are lying on the jurisdictional high court, the Kerala High Court, and not offering a particular income to tax. Let's say you are treating it to be a capital receipt. By the time the assessment is framed, let's assume the Kerala High Court is reversed by Supreme Court. Asking officer will make the addition. Can somebody say penalty should be levied on this? I would think that penalty should not be levied, and 100% it will fall within the first clause or exclusion provided for in subsection 6 to 270 capital A. Because there are already questions that are coming in the chat box. I'll try to deal with them as I'm speaking, but very specific queries, I will request the organizers to make note of what I'm not answering and I'll try to answer them towards the end. Now, of course, I had specifically stated that 144 may not be eligible for immunity under 270A. The querist says that 144 is not a standalone section. It is always read with 143. So immunity can be claimed under 270 capital A. I do not subscribe to this view because a regular assessment can be framed under 143.3 or 144. That's how regular assessment itself is defined. Right? So if an assessment is framed under 143.3, your immunity is definitely available. If it is framed under 144, because of non-cooperation on your part, then penalty is not eligible. Sorry, then the waiver or the immunity is not available. Right. This is my personal view. I may differ from the view that this querist has in his mind. I might be wrong also, but this is my personal view for the time being. Right. Now, what happens when there is both additions in respect of which some are underreporting, some are misreporting? I already explained this and said that you cannot file an appeal against the order if you go for an immunity. So it may not be advisable to go for an immunity. You should only file an appeal. Likewise, the larger questions can arise. Larger questions can arise. Supposing the assessing officer has initiated the penalty saying it is underreporting of income. I move an application in form number 68. Can he say, no, this is not underreporting, this is misreporting? Or alternatively, he has initiated it saying it is misreporting. But when I go under the provisions of 270A, can he say, no, this is only underreporting, I will grant the immunity? These are questions for which there are no answers. But then, in my view, application of mind is but a mandatory requirement. So he should examine in each and every case whether I am entitled to immunity merely because he has written misreporting. Can he deny me my right of being granted the immunity, which otherwise is eligible for me, and which is only a case, and if it is only a case of underreporting of income and not misreporting. Likewise, if you see the provisions, it says you should not have filed an appeal against the order. And if one's immunity is granted, you should not file appeal against that order or even go under 264 against that order. But nothing prohibits me from filing a 264 before moving the immunity application. In fact, there is a direct decision of the Bombay High Court on this point called Harun Textiles, where the Bombay High Court says that 264, filing of a 264 does not bar the moving of a 270 AA application. So if you want all your remedies alive, file a 264, go for an immunity. If you don't grant the immunity, pursue the 264. That is one possibility. Go for an immunity. If immunity is not granted, pursue an appeal. Go for an immunity. If immunity is granted, forget about the 264, withdraw your 264, withdraw your whatever, and come back and be happy. But then also remember that the orders that are passed under 270A AA are also orders. Now, Section 263, revisionary power of the Commissioner, says every order of an assessing officer can be subject to 263 if it is erroneous and prejudicial to the interest of the revenue. So, can a 270A be subject to? The answer is yes. I would think that it should not be, but unfortunately, the answer is yes. Because I don't see an exclusion in 263 for 270 AA. So you go ask for immunity, immunity is granted, even that becomes uncertain. Right? The whole idea is to get some certainty and close the chapter. Right? Next, can it be subject to 264? The answer again is yes. Because 264 says any order passed by a subordinate court. Now, the last issue that I will deal with, or rather two issues, is that you will see that nothing stops the assessing the commissioner or the principal commissioner from taking up the order which has been subject matter of assessment or the assessment order under 264 suo motu. The law provides that you cannot go under 264 once immunity is granted. But the commissioner can suo motu take it up under 264 and grant you any benefit that he thinks you are appropriately entitled to. There is no bar on that. Only you cannot move the commissioner. Likewise, in cases where there is a direct appeal that can be filed before the tribunal, or that should be filed before the tribunal, there is no bar on filing an appeal before the tribunal in the provisions of 270 AA. Let me take an example. There is a transfer pricing matter. A transfer pricing adjustment is made. You go to the DRP. The DRP confirms the transfer pricing adjustment made by the TPO. The assessing officer passes an order under 143(3), read with 144C, giving effect to the order of the DRP. You have to go directly in appeal to the tribunal. You go in appeal to the tribunal, you also apply for a waiver or an immunity under 270 AA. Whether you can do so, in my view, the answer is yes, because there is absolutely no bar. There is absolutely no bar on your seeking the immunity after filing an appeal before the tribunal. This runs is so far as the direct provisions of 270A and 270 AA are concerned. Now, what I will do is to deal with some of the other income-based penalties before I go into some of the aspects relating to prosecution as well. But before that, I think I have one more question in the chat box. When mutuality of business applies, can AO impose penalty for non-disclosure of income? Friends, if the income itself is not accessible to tax, then the question of an addition is not at all justified. If the addition is made, then if the assessing officer feels it's an underreporting of income, you pay the tax and go for an immunity. If he feels that it is an underreporting of income, you want to file an appeal, If the addition is deleted, automatically the penalty will go. The same will happen for misreporting also. But then one larger question is, supposing I levy penalty as an assessing officer for misreporting at 200%. Can the AO reduce it to 50? Sorry, can the CID appeal reduce it to 50% saying, no, this is only underreporting? The answer is yes. I have no doubt in my mind. But then in such circumstances, I have lost my valuable right of going under 270 AA for immunity. The law does not provide for what will happen in such cases. The case is a fit case for levy under reporting. The officer inadvertently, incorrectly levies it for misreporting. Commission of Appeal rightly converts this to underreporting. Now I have to pay the penalty. I cannot go for the immunity. Because immunity can be only from the assessment order, not from the appellate order. The time would be lost. Because 1 month from the end of the month in which the assessment order is received is the time for filing the form number 68. That time would have elapsed also. I quickly deal with 271 AAB. 271 AAB deals with the year of search and the immediate preceding previous year for which the time limit for filing the return of income has not expired. Now, this is something where they say that in these two circumstances, penalty will not be exigible under 270 A, but will be exigible under 271 AAB. But then they seem to have very badly phrased it. Because if you see the language that is used in subsection 6 of 270 A, subsection 6 says the amount of undisclosed income referred to in 271 AAB. Yes. So if it is an underreporting, 271 AAB will not apply. But if it is a misreport, 271 AAB will apply, 270 A will not apply. But if it is a misreporting, what happens? They don't seem to have said that at all. Right? Again, simple drafting error. One has to see how to exploit the mistake. And 271 AAB contemplates of two scenarios. One is a scenario where in the course of search, you are questioned under 132.4. You specify the manner in which you want the income, substantiate the manner in which you want the income, and pay the entire tax on the undisclosed income along with interest at the time of furnishing the return of income. Then the penalty is 30% of the undisclosed income. Otherwise, it is 60% of the undisclosed income. But then interestingly, 271 AAB can be levied only by an assessing officer. Nowhere does it provide that it can be levied by a person other than the assessing officer. Now the question arises, what happens in connected cases? See, what happens is like A is searched. In the course of the search of A, money belonging to B is found, or assets belonging to B is found, income belonging to B is found. Now, B can also be assessed. Will he fall under AAB or 270A? In my view, B will fall under 270A, not under AAB. Though the income arises from the search, it does not arise from his search. Why am I saying so? Since it does not arise in his search, he cannot be examined under 132.4 at all. And the requirement is that he should be examined under 132.4. Therefore, penalty in such case can be levied only under 270A on B and not under 271 AAB. You have 271 AAC, which deals with penalty where an addition is made under the provisions of 68 to 69D. And where they provide that the penalty will be 60% of the income as increased by a surcharge of 25%, which means that the penalty will be 75% over and above this, whatever penalty must be levied. The tax itself is 60% plus 25% under 115 BBE. Penalty is 10% if the addition is made by the assessing officer. 10% of the tax, that means 6% of the income will be the penalty. So you can imagine 60% tax plus 25% surcharge plus whatever additional surcharges, your tax will come to something like 77.25%. Over and above that, a 6% can be levied under 271 AAC. Again, remember, 271 AAC is only in a case where the addition is made under 68 to 690 and can only be initiated by an assessing officer. It cannot be initiated by a commissioner of appeal, a principal commissioner, or a commissioner of income. Right? I don't know why they have provided for it. You also have one of the latest provisions in 271 AAD. Okay. 271 AAD is a provision inserted with effect from assessment year 2021. And what does 271 AAD provide for? It provides for a penalty if it is found that in the books of account maintained, there is a false entry. Please don't. There is a false entry or a omission to make an entry which is relevant to the computation of total income of such person with a view to evade tax liability. False entry or an entry which is an omission, but with an intention to evade tax liability. Now, friends, before I proceed to discuss on 271 AAD, I will read from the memorandum explaining the Finance Bill 2020 on the purport and purpose of section 271 AAD. The memorandum reads like this. In the recent past, after the launch of GST, several cases of fraudulent input tax credit claimed to have been caught by the GST authorities. In these cases, fake invoices are obtained by suppliers registered under GST to fraudulently claim ITC, that is input tax credit, and reduce the GST liability. The invoices are found to be issued by racketeers who do not actually carry on any business or profession. They only issue invoices without supplying any goods or services. The GST shown to have been fraudulently charged on such invoices is neither paid or intended to be paid. Such fraudulent arrangements deserve to be dealt with harsher provisions. Therefore, it is proposed to introduce a new provision to provide for levy of penalty on such person if it is found during proceedings that in the books of account maintained by him, there is a false entry or an entry relevant to the computation of total income, which has been omitted to evade tax liability. Now, if one reads this memorandum, it appears that the penalty is only exigible under 271 AAD in a case where there is a false entry or where the entry is omitted with an intention to evade tax liability. If it is a GST related input tax credit that one seeks to take based on such entry or false omission of entry. But unfortunately, if you see the section and the wording, it is not dealing only with GST. It deals with everything. Therefore, in my opinion, the memorandum cannot override the statute Therefore, 271 EAD will apply to every case of false entry or every case of omission of an entry with a view to evade taxes. Right? Again, 271 AAD is interesting in that it does not give the power to the commissioner appeal, the principal commissioner or the commissioner. The power under 271 AAD is vested only in the assessing office. It is vested only in the assessing office. Now going further, subsection 2 of section 271 AAD provides that without prejudice to subsection 1, the AO may also levy penalty on any other person who causes the person to make the false entry or omits an entry. Right? So what happens if you have made a false entry in your book, say, and I have consequently omitted to make that entry in my books? Penalty can be levied under 271 AAD on both of us. May look unfair, but that's how the provisions are worded. Now, the first question is, what happens to a third person? Let's assume there is a false entry in the books of A or a non-entry of the books of the entry of the same in books of B. But this was facilitated by C. Can C be liable for penalty under 271 AAD? I'm talking the broker for the entry. In crude words. In my personal view, he cannot be liable under 271 AAD. There are separate provisions to deal with it, and 271 AAD is not one of them. Likewise, what happens if the person on whom the original charge under 271 AAD is applicable is for some reason exonerated? Relief is granted to him. Then automatically, in my view, subsection 2 should also fail. Now the term false entry. I think I'll pause here after finishing this aspect. If you see false entry, the term false entry says a false entry includes use or intention to use. Very, very, difficult language used. Use or intention to use forged or falsified documents, such as false invoice or in general a false piece of documentary evidence. B, invoice in respect of supply or receipt of goods or both issued by a person to any other person without actual supply or receipt of goods or services or both. C, invoice in respect of supply or receipt of goods or services or both to and from a person who does not exist. Right? Now you will see that the language used is includes, use or intention to use. So which means 271 AAD, the definition of the term false entry is an inclusive definition, not exhaustive. The scope can be increased. Right? Now, I don't understand some aspects of 271 AAD as well. These are yet to get started implementing, they are yet to start implementing these provisions, but as they implement, it's going to be very, very, difficult to handle these. It is going to be extremely difficult to handle these. And what does it provide for? It provides that an intention to use itself can result in a penalty. How can an intention to use result in a penalty? Penalty is equal to the amount of false entry or entry omitted. Intention to make a false entry. How can that result in a penalty? That cannot result in a penalty. There can be no mens rea that can be presumed against me. But the language uses intention to use also. I am afraid that in real life, intention to use penalty for that cannot be levied. This is so far as 271 AAD is concerned. What I will do is I will pause here for some time on the context, in the context of penalty, and quickly deal with some of the aspects relating to prosecution, and particularly with reference to compounding, because there have been substantial amendments made by a notification issued in 2022, which has substantially reduced the rigors of the compounding in case of prosecution. Right? Now, coming to prosecution as such, there are various provisions dealing with various kinds of or various quantums of prosecution for different offenses. For example, failure to file a return can result in a prosecution. Evade taxes can result in a prosecution. Evade the liability to collect can result in a prosecution. Non-deposit of TDS, TCS, etc. can result in prosecution, etc., etc., etc. So there are a number of circumstances that are contemplated in relation to prosecution, where they say prosecution can be launched for different reasons. Now, friends, what I have done is I have circulated some material with the organizers for various aspects relating to both the penalty, which we will discuss, and prosecution also. Now, for obvious reasons, it doesn't make much of sense for us to discuss what is the quantum of prosecution for each and every offense. See, for example, sometimes it may be 3 years rigorous imprisonment, sometimes it may be 6 months imprisonment. Those are things that we will not discuss. Those are things that I have tabulated and put it across in a table which is before with the organizers, which I am sure they will circulate among the participants. But there are other aspects which we need to discuss in the context of prosecution. Friends, in the meantime, if there are any queries that you have on the penalty provisions that we have discussed so far, I would urge you to either put it in the Q&A or in the chat, or rather any one of these, preferably in the Q&A column, so that I can keep track of the questions that are being posted. Right? I can keep track of the questions that are being posted. Or rather, the organizers can decide, sir, which is better, the Q&A or the chat?
So Q&A is better.
Q&A is better. So if you can keep posting it in the Q&A, I will try to assimilate my thoughts on the Q&A as well and try to answer. Now, coming back to the provisions of prosecution, first thing is you will remember that there is a provision called 278 capital E in the Act, which is one of the most dangerous provisions in relation to prosecution. And what does 270 capital E provide for? It says, in any prosecution for an offense under this Act, which requires a culpable mental state on the part of the accused, the court shall presume the existence of such mental state, but it shall be defense for the accused to prove the fact that he had no mental state with respect to the act charged as an offense for that prosecution. And then they say culpable mental state includes intention, motive, nor knowledge of fact or belief in or reason to believe a fact. And then it says the fact is said to be proved only when the court believes it to exist beyond reasonable doubt and not merely when its existence is established by preponderance of probability. So, the court, by virtue of the provision of 278E, presumes a culpable mental state. Which means that if there is any offense that you are said to have committed, you are presumed by the court to be having a culpable mental state or a mental state where you wanted to do the crime. It is on you to show beyond doubt, not by preponderance of probability, by beyond doubt that you did not have such a culpable mental state. I think this is an extremely dangerous provision which is there in the Act. Because normally in any criminal offense, the onus is on the person who is charging you with the offense to prove beyond doubt that you have in fact committed the crime. But in income tax, it is the other way around. You have to prove beyond doubt that you did not have a culpable mental state. But the commission of the offense has to be proved by the person who is charging you of the offense. A. B. This presumption as to culpable mental state is applicable only to the court. So, if a person is initiating prosecution on you, the principal commissioner is initiating prosecution on you, he cannot presume a culpable mental state. There is nothing provided for that in the Act. So, he has to satisfy himself beyond a doubt that you had a culpable mental state. It is only the court which can presume that you had a culpable mental state, not the initiating officer. Right? Now, as I said, I am not running through the list of various kinds of offenses. But then we have to understand who are the persons against whom prosecution can be launched. Oh, well, in case of companies, it becomes very, very simple. In case of individuals, the individual concerned. In case of the karta, in case of HU of the karta, etc. In case of partners, partners in charge, etc. But in case of a company, the person who can be charged is not merely the company, but also the director, manager, secretary, or every other officer of the company who is said to be involved in the affairs of the company. Or with the consent, connivance, or attributable to the neglect on the part. So, if he can prove that it was without his knowledge or despite due diligence, then penalty cannot be exigible on him, on such director or person who is involved in the affairs of the company. It should also be proved that the person was in charge of the affairs at the time when the offense was committed. Right? It cannot be generally on all directors. Who was in charge of the affairs of the company at the time when it was committed is irrelevant. Right? Likewise, there can be directors who are only technically skilled and they may not be in effective control. Whether prosecution can be launched against them, the answer should be no. Likewise, you will see that in all cases of prosecution, if the person has prior to detection made a full and true disclosure and has cooperated, then prosecution should not lie. Likewise, where there is genuine hardship and the SC has cooperated, prosecution should not lie. Now, there are other questions that rise. During the pendency of appeal, can prosecution proceedings be launched? There is no bar on the launch of prosecution proceedings during the pendency of proceedings under the Act. For this, you have a direct decision of the Supreme Court in a case called Jayappan, where the Supreme Court would hold that pendency of appeal is not a bar for launch of prosecution proceedings. Now, is there in every case a sanction that is to be received? Yes, a sanction has to be received in each and every case where prosecution is sought to be launched. But should a hearing be given before the sanction? The answer is no. Normally, before launching prosecution, they give you a show cause notice. But for sanction, there is no need for a show cause notice. Likewise, what happens when penalty is dropped, whether prosecution can lie for the very same offense. If penalty is dropped for a particular offense, then for the very same offense, prosecution cannot be launched. For example, somebody says concealment of income, evasion of taxes. Penalty itself is dropped. Can prosecution continue? The answer is no, because the offense is the same and prosecution is a higher punishment. If penalty itself is not leviable, prosecution should also not be leviable. Likewise, one will see that normally a tribunal order will have great effect in persuading a court not to prosecute you. But that will depend again on facts and circumstances. If the tribunal has granted you the benefit not on merit, but on technicalities. For example, we have a case where the penalty was levied, the assessment was completed, but we took a plea that the assessment was time barred. Additions were made, penalty was sought to be levied, prosecution was sought to be done. Whether prosecution can continue, the court said prosecution can continue, though quantum has not survived. So the survival of the quantum, they said, is not necessary for that purpose. But normally, if a tribunal grants relief on merit, then that should bind a trial court, because the offense that is said to have been committed itself ceases to exist. That is evasion of taxes. Penalty drop cases, penalty prosecution should not lie. Likewise, what happens in a case where, you know, there is an abettor to a crime? Right? What happens in a case where there is an abettor to a crime? A has said committed the crime, B is said to have abetted it. A for some reason is acquitted. Can proceedings continue against B for abetting? The answer is yes, it can continue against him for abetting. Because B may be able to demonstrate that he did it without knowing, without his knowledge. It will have to be ensured that B is able to demonstrate in a similar terms that he was not having a guilty mind when he made the advice to A. I will probably, take a little while to deal with the new compounding provisions. These become very important because these have substantially expanded the scope of compoundable offenses, A, and it has made compounding a little easier also. Right. Now, friends, broadly speaking, where all have they made or have they liberalized compounding? I'll just take a few illustrations. For example, earlier, only convictions beyond 2 years could be compounded. If it is for less than 2 years, no compounding was permitted. Now they have increased the scope of compounding to say, even if the offense is punishable with 2 years or less of imprisonment, compounding is possible. Next, earlier compounding applications had to be made within 24 months from a stipulated date. Now they say in certain circumstances, you can make it up to 36 months from the stipulated date. What are these stipulated dates? I shall come to. Likewise, certain upper limits have been introduced for compounding fee, covering several defaults. And the interest, the penal interest that is payable, which earlier was 3 and 2%, has now been reduced to 2 and 1% respectively. So you will see that the scope of compounding has increased. In some cases, even the quantum of fee that may be payable has reduced. Now, broadly, offenses are classified into category A offenses and category B offenses. Category A offenses being lesser or smaller offenses, like failure to deduct or failure to remit tax deducted into government account, failure to furnish return of income, failure to comply with or abatement of false returns, etc. These are slightly lesser defaults, which are classified as category A. Category B is more serious offenses, like willful attempt to evade taxes, willful attempt to or failure to produce books of account, etc., false statements made, etc. Right? Now you have two kinds of offenses. Now normally offenses can be compounded only once if it is a category B offense, that is more serious offenses. But if it is a category A offense, compounding can be permitted up to 3 times. It can be permitted up to 3 times. Now, what is the conditions to be followed? You are supposed to make an application in the prescribed form. The prescribed form is provided for in the notification itself, along with an affidavit of ₹100 in a ₹100 stamp paper before the PCCI.
So there is an issue.
CIT, CCIT, PGDI. File an application beyond 12 months also, but. Am I audible?
Yeah, you are audible, sir. No,
yes.
There was like issue.
I am getting a message that my internet connection is unstable. That's fine. Yes, sir. So we have a situation where you want to go for a compounding. You should normally go within 12 months from the end of the month in which the complaint is filed before the court. You can go even before the complaint is filed before the court. Please remember. But normally within 12 months you should go, maximum. If you go within that period, that is within, before the complaint is filed or within 12 months of the complaint being filed, then you pay the compounding fee alone. But if you go beyond 12 months and up to 24 months from the date on which the complaint was filed, you pay 1.25% of the compounding fee. Now, in certain circumstances, in deserving cases, the PCCIT may condone the delay and permit you to file an application even beyond 24 months and up to 36 months from the date, from the end of the month in which the court, the complaint was filed in the court. In such a case, the compounding fee will be 1.5 times. Now, for filing a compounding application, you must pay the entire tax before filing the application, the entire interest and the penalty, and also the entire interest under 222 before making a valid application for compounding an offense. The person who is making the compounding application has to give an undertaking that he will pay the compounding charge, and he must also withdraw the appeal filed by him or the grounds which relate to the offense which is said to have been committed for which he is compounding. Now, for example, if 2 additions have been made, on one alone you are seeking compounding, you must withdraw grounds in relation to that one only. The other one you can pursue in appeal. Right? You can pursue in appeal. Now, I have already said who is competent to compound the offense. Now, what is the procedure? You make an application. the concerned compounding, the concerned authority who is entitled to compound, that is the PCCIT, the PGDIT, the CCIT or the DGIT, calls for a report from the assessing officer, and then which the competent authority checks before granting. He is normally required to pass an order in speaking if he is refusing to compound the order, the offense, or he should, if he finds it acceptable, pass an appropriate intimation granting you the compounding subject to the fee that is payable in the intimation. Please note that the notification says he should pass this order or the intimation within 6 months from the end of the month in which the application is made, but then further goes on to say that this is purely indicative. The time limit is purely indicative and is not binding on the compounding authority. Okay. Now you get a time limit to pay the compounding fee. The time limit to pay the compounding fee normally is 1 month from the end of a month in which the intimation is received from the competent authority. 1 month from the end of the month in which the application, the intimation is sent for by the competent authority. But extension can be granted on a request from the applicant in exceptional circumstances, and extension can be granted up to 6 months by the competent authority. But you have to pay 1% per month as interest for the first 3 months, and thereafter 2% per month for the balance after 3 months period. Likewise, with the previous approval of the PCCIT of the region, the extension can be granted beyond 6 months and up to 12 months, but 2% interest has to be paid on the unpaid amount beyond the 12-month period, beyond the 6-month period. Beyond 12 months, the member investigation CBDT can grant extension for payment to the compounding fee, but again, the interest of 2% will keep running. Now, the compounding condition I said is that you pay the taxes within or the compounding charge within the stipulated time, with or without interest, as I discussed earlier. And once you make and pay the entire fee, the compounding authority can grant you or will issue you an order granting you the compounding. And when that is given to you, you should intimate the court immediately so that there is no further prosecution that will lie. Of course, if there is a shortfall in the payment, if it is for bona fide circumstances, then the shortfall can be made good. The shortfall can be made good, but interest will still be chargeable. This is what the procedure is for compounding. Now, there are various charges that are payable for the compounding, which I will refrain from discussing at this point in time. Because for each offense, the fee that is payable or the compounding fee that is payable may vary. So it is like this. There is a compounding fee for each offense. Depending on the time frame within which you have moved the application, from the date on which the complaint has been filed in the court, your compounding fee may be equal to this compounding fee stated in the table, or can be 1.25% or 1.5%. The compounding charge will be determined. You must pay the entire tax, interest, penalty, including 222 interest, and then the compounding application is moved. You move the compounding application. The compounding fee is determined. You pay that compounding fee within the stipulated time, with or without interest, depending on the time frame within which you pay it, with the approval of the competent authorities. Right? Who can be the competent authority for the compounding itself, or the principal chief commissioner of income tax of the region or the member investigation in charge of affairs. Depending on that, you pay, and then the compounding order is passed, which you file with the court, so prosecution will not lie against you. Now, what will happen if there is offenses by companies and Hindu undivided families? There they say that if the offense is committed by a company or a Hindu undivided family, a compounding fee of 10% of the compounding fee of the main offense shall be charged on the person who has been in addition charged. For example, if the company is coming for the compounding and the director has been charged, the director has to pay another 10% further compounding fee. Right? They say the competent authority may, after considering the extent of involvement, enhance or reduce or waive the compounding fee on a co-accused or the abettor. And further, unless the main accused comes forward to compound the offense of the co-accused who does not make a compounding application. So if a company is coming on a compounding application, but the director who is a co-accused does not come, the company has to pay the compounding fee of the director also. They have to give that undertaking. Right? Otherwise, the co-accused can also come on a compounding application and he can get the compounding. And co-accused minimum fee will be 1 lakh. Of course, it is 10% subject to a minimum of 1 lakh. In extreme cases, the finance ministry can reduce the charges for compounding, etc., is what is provided for in compounding. Now, what I will do, friends, is to pause here. I have 1 or 2 more questions to take. If there are any further questions, I will take them. Otherwise, with the permission of the organizers, we can wind up. One of the questions that has been raised is, in case of a trust, the assessment was completed on basis it was carrying on business and not a case of relief to the poor. It is pending in appeal on the same issue. In the meantime, penalty under 271B is levied. Is that correct? Now, 271B is for failure to get the accounts audited, isn't it? 1 minute, let me check. Failure to get accounts audited. So, if you have not got the accounts audited, 271B is an independent penalty. Even if there is no assessment, 271B proceedings can be initiated against the SSA. So that charge has to be held or has to be argued independently. I don't see any reason why the pendency of the appeal will act as a bar on initiating 271B proceedings. I think most of the other questions I seem to have answered.
Yeah, we already answered, sir. Nothing is pending now.
Yeah.
Okay. Are you winding up, sir?
Yeah, if there are no further questions, we can wind up, sir.
I think there is no more questions. I think all the questions you have answered already. Okay, thank you, sir. Your session was very informative and mainly on practical aspects. And we are really honored to have you as a speaker for the day. Thank you very much. Now, I request the technical team to present him a momentum virtually as a token of gratitude. Technical team, please. Sir, this will be physically delivered in your present address at the earliest. Thank you very much. And now I request C.A. Prashant, sir, our secretary, to say a vote of thanks. Over to you, Prashant. Prashant, line is mute.
Thank you, sir, and a very good evening to one and all. It is an honor and privilege to represent Kollam branch and to propose vote of thanks on this 5th day of NAVARATNA seminar. Once a great one said, feeling thankful and not expressing it is like wrapping a present and not giving it. So today I take this opportunity to put all my gratitude into words. We had an excellent session today, and I would like to start by thanking our chief faculty, eminent faculty, C. Bhanusekar sir from Chennai, for giving us an insightful session on penalties and prosecution. On behalf of all the 9 NAVARATNA branches of ICAI and on behalf of all the participants, I would like to extend our heartfelt gratitude to C.A. Bhanusekar sir. Thank you, sir. Thank you for sharing your valuable knowledge. Next, I would like to thank our Chief Guest, Pradeep Kumar sir, Assistant Commissioner, GST Kollam Division, for accepting our invitation and inaugurating today's session. Thank you, sir. Thank you for your time. Next, I would like to thank our dearest C.A. Sadishan P. sir, SIRC Chairman of SIRC of IC, for taking initiative in bringing all the 9 branches together and organizing this 3rd season of NAVARATNA program. Thank you, sir. It's a great platform for all the branches to collaborate with each other. Next, I would like to thank all the chairman and managing committee members of all the branches in Kerala for coming together for this 9 days program and contributing for its success. Special thanks to Thrissur branch and Palakkad branch for coordinating this program wonderfully well and providing technical support. Lastly, on behalf of Managing Committee of Kollam branch of ICAI and all the NAVARATNA branches, I would like to thank all the participants for attending this program and making it a grand success. We had a participation of around 270 members. That was wonderful. So thank you all. Have a great event.
Thank you, Prashant. Now I request everyone to pay attention for the national anthem. Technical team, please play the national anthem.
Janagana mana adhinayak jaya he Bharat bhagya vidhata Punjab Sindh Gujarat Maratha Dravida Utkala Vanga Vindhya Himachala Yamuna Ganga Uchchala Jaladhi Taranga तव शुभ नामे जागे तव शुभ आशीष मागे गाहे तव जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे.
And tomorrow we have technical session, standards on auditing for small and medium practitioners, which will be hosted by Ernakulam branch. Request all members to participate in the program. And once again, thank you all. Thank you, Bhanusekar sir. Thank you all participants.
Thank you.
Thank you. Thank you. Yes, sir. Thank you.